Hi, welcome to this technical call. Um, I don't know if you guys know who I am, so I'll just introduce myself. I'm Richard Bourgault. I run a company called SegStream. We've kind of been putting on these technical calls to kind of, just keep up with the zeitgeist in the space, the specialty tax space, and other accounting topics that are peripheral. And I am joined again by Dawn Poland and John Denovich. So I'll just hand it over to Dawn. She'll introduce herself, and then John. Dawn.
Thanks, Richard. My name is Dawn Poland. I am a CPA who has been working in this space for many, many years. I work very closely with John and Richard, and I'm looking forward to having a great chat with you today.
John?
Yeah, my name is John Denovich. I'm the managing director at the Jennings Denovich Group, cost seg firm. We use Richard's software SegStream, and I've been doing this about 25 years. So, we've all worked together, Richard and I and Dawn, for many years. And so, we're hopeful that some of the topics we discuss are helpful to you.
Yeah, excellent. Nick, what were the topics? What are the topics that
I have them. Nick
Oh,
sent them
okay.
to me. What's in the pipeline for cost seg with the new administration, which goes right into our conversation earlier.
So
What's the recent trends in cost seg and the bonus rules, surrounding really where we're headed?
I would normally take that, but I am trying to find the person who's
so there's a few people
sort
that
of
be muted. Yeah.
Yeah, I'm trying to mute everybody.
So what's
okay,
in the
I think I got it.
for cost seg, with the new administration? I mean, this is a topic
Right.
we could probably sit on for a long time. I mean, there's a lot of speculation. I have heard a few people speak on this, what they think is going to happen. I, for one, have
Let's
been
hear that speculation.
surprised at what's happened so far, with Trump.
Let's get the juice.
What I have heard, the word on the unofficial street is that bonus depreciation will come back and be retro as a 100% bonus as a 1/1/25. But we won't get that information. It probably won't pass until July. So pretty much everyone.
Wait, so they're not gonna push it back to 2023, you mean?
It's doubtful. Yeah, I don't think that they would do that, to be honest. That you're talking about amending too many returns and things like that. I think the best we can hope for is a 1/1/25 change. Yeah.
Okay. All right. Well, that's not as juicy as I thought it was going to be. I thought for sure they were going to go back, because that was the idea with the legislation last year, was already slated to go back to 23. I thought, wasn't it?
No, I don't think so.
I
think what was on the table last year was.
Huh. That's interesting.
Yeah, I mean, I could be wrong on that. I mean, but I didn't think.
Well, you probably know better than I do.
Yeah,
John, is that
follow it?
Did you were you ever under the impression that was supposed to go back and be retroactive to 2023?
Well, the last time they had major legislation in Trump that went back to like the previous year, but to September 27th. It was like 9/27, so it started kind of 2018, January 1st, but they made it retroactive, but only like a few months. But like Dawn says, it's the timing of the legislation. You've got everybody filing, filing in March and April. So they would all have, issues with, oh my goodness, I didn't, because the CPAs maybe taking 40% bonus. And now, how are we going to adjust this? All these K1s and all these tax returns.
Yeah.
It would be, if they did it in July, it would be before the extension period. We just never know. We've had it, we've had retro before, one of those extender packages, over the years. So you just never know. They do whatever they want. They cause a mess.
I mean, they did retro for a QIP because that was an error on their part.
Right.
So, I mean, going retro back into like a current year is one thing, and going retro back into a years back is a completely different thing.
Yeah. Okay. Well, yeah, I mean, unless somebody else has something else that they've heard that they want to kind of bring up right now, I think we can move things forward. I don't know if anybody wants to speculate on anything. I'm surprised I haven't heard anything like they're just going to abolish it, just expense your building. You haven't heard that one yet?
No, I haven't heard that one yet.
See,
no.
I'm going to start that rumor on this call.
Yeah.
Just kidding, guys. I have not heard that.
Hey, Richard, it's Steve.
Hey, what's up?
Oh, good, man. All good. Don, quick question on what you are hearing on the streets since you've got your ear to the pavement. Is it 100% retro January 1 moving forward without an expiration date from what you're hearing, just 100% on a move forward basis, or what are you hearing in that regard?
I didn't hear whether there would be, it would just be open.
A
I
sunset?
doubt very seriously. I think all of these things, I meant to actually go back over their note, their cycles, and they kind of discuss this whole budget cycle. And I think that it's very difficult to get things permanently passed. If the max we would get would be like through the next budget cycle would be at X amount of years going forward.
Yeah, I heard that it's so basically there's like, I guess I don't even know if it's parliamentary or whatever. There's some rules, some sort of set of rules that's supposed to, like, any kind of like budget stuff can't go past like 10 years. And I think there's actually like a buffer around that. So because the last time they didn't make them permanent, and I think that was the part of why they did it, was because they can't actually set these things and make them permanent. Yeah, I wouldn't be surprised if you saw it go on forever, I think, but probably definitely for the next 4 years.
Well, that's a big windfall either way. That's a big win.
Yeah.
For sure. I mean, the good news is that CONSEG itself won't ever go away, in my opinion, because it's born out of court cases. They would have to overturn all of those court cases, unwind all of that. So it's not as easy as just a one fell swoop. I just get rid of this one rule. So, we do, ride the wave with the bonus, but at least COSEG itself is pretty encapsulated with that.
Not if the rumor that I heard comes to pass, where you can just expense your building.
Oh, okay.
Okay, you bought a building, just expense the whole thing. Good, done. Amortization, set. Okay. Well, unless somebody else wants to chime in here, maybe we should just kind of move forward to the next thing. I'll give a second for everybody to come back if they want. We should have the Jeopardy music for this part, but we don't, unfortunately. Probably get sued anyway. All right, so I don't think that sounds like that there aren't too many people that are interested in chiming in. So what is the next topic there, Don, since you're so helpful?
It was well, the yeah, it was bonus 60%. Yeah, when John was mentioning the 40% bonus by this year, I think is what he was referencing. The recent trends in cost seg, and then the last one is the bonus rules. So really, the recent trends, I don't know.
What have you been hearing about? I mean, obviously things are going to change is the problem, right? So it's like, but like the recent trends being like what's being audited and like what's been happening. I guess we just don't know how contemporaneous that'll be, considering the sort of onslaught against IRS budgets right now. But I guess we can talk about that. Let's I mean, I think we did go over this on the last call pretty heavily. Like, okay, what is it that they're actually that they're really looking at? And it seems like a lot of it has been around like cabinetry and in residential has come under fire as far as being in personal property. Anything else that, John, do you comes to mind?
Why have they been looking at cabinetry in residential? Like, what's their stance on that?
It's the South
go ahead, John.
It's the Mirror South case. And
it's back to that. Okay.
And they're even citing it in the audit technique guide, which is the bad thing, because that's a really bad case. It's a horrible case. And if anybody knows anything about it, it was not the people sold their property. The IRS took it to court, and it wasn't defended. So they just did whatever they wanted, and then now it becomes a tax case. No one.
Right. They're using it as a precedent.
Yeah, they took things that have been done for years that is totally accepted, like landscaping and things like that. And they threw it out. So one of the things they did is because of a lot of residential. It just for years it's been kind of pretty accepted. You take the kitchen sink and the cabinetry, while they're disallowing that. Now, not all the cabinetry, but like they're basically trying to say that the kitchen cabinetry, you know, like the upper and lower, you know, by the sink, you know, that is standard and is part of a typical residential, and that would be a long life item, 27.5. Now, if you have additional cabinetry like pantries and shelving and additional cabinetry, you know, above and beyond, you know, that's one thing. But yeah, throwing that out, and depending on the agent, and many of these agents are brand new, they have been inexperienced. They basically, what they're doing is they're throwing out the case, they're saying you can't use it, and then they kick it upstairs to a more senior, and it kind of dies there. We've actually seen several audits that just died because once the IDRs went out, got answered, never heard anything for 2 years, and then the next thing we heard was the agent retired, and it got given to somebody else, and it died on the vine. So audits are, you know, we're not seeing a lot of audits, and with the hiring freeze and new agents coming on that aren't experienced, you know, you would think that there's even going to be less audits. I know that at one point they went over high wealth individuals, so that's a small percentage, and they did a lot of audits. And the last thing they said they were going to go after was LLCs, you know, with partnerships, you know, because they think some of that stuff has been abusive. But now with the freeze and everything and the new administration coming on, it's hard to say, you know, what would happen next, but it looks like less auditing right now.
We have been seeing a little bit of an uptick though in cost seg audits in general, right? But they've been more messy because the agents have been more green. And so they've been taking just a lot more time on professionals' part to kind of work through it, right?
Yeah. Well, this is a great question. I love this question about AI because and obviously we could all speculate about this, but yeah, I mean, it looks like you're going to have, it's funny too, because this is something that I've been hitting a lot in like our advertising for SegStream. It's like, hey, you've got less talent. There's a talent shortage. It's hard to hire for, so use AI to sort of like to do less with more, do more with less. Well, yeah, what if the IRS, I think the IRS and most of the government, at some point will catch wind of this type of development, right? We know, government and typically is slow to the punch here, but yeah, I mean, at some point you would think you're going to have, IRS agents that are just bots that are just going through and trying to get trained on, on all of the data from previous years. Hey, we audited this person because of this. We audited this person because of that. If you can train a bot to do this, yeah, I mean, compliance could get a lot more rigorous, even at every level, right? Right now they just have to do a sampling, right? They just have to say, okay, we're going to sort of arbitrarily pick people out from different demographics, and hopefully they're trying to pick out. I mean, that was the whole thing with the LLPs and stuff and high net worth individuals. Those people are getting away with a lot more, and as everyone knows. So you can probably cherry pick more, or you could even just choose a higher percentage, to sample a higher percentage of those people. But yeah, I think at some point definitely in the next decade, if not in the next 5 years, you would think that anybody who's probably 5 years from now, right? I think there won't be a dollar placed on the budget for AI for IRS in the next 4 years. Probably, but I would think that's something we definitely need to worry about, kind of going forward afterward, is like once a new administration takes hold and things kind of like progress past past what we can see now, yeah, I think software is a big could be a big aid to just parsing all this mountain of data. And yeah, they could do a lot more rigorous auditing without having to actually lift a finger yet, and then just identifying whether people are, look like they're in compliance or not, to go ahead and pick up those files with humans.
I mean, that's basically already been happening, Richard. I mean, I call it the big computer in the sky, but when you check certain boxes and you think about like Form 3115, that's 8 pages of just question after question after question. And those are, and even on your 1040 now, do you have digital assets? All these questions are throwing you into a bucket. And then that big computer in the sky just automatically sends out notices. I don't know how many people have gotten these over the years, just that you have to reply back to and say no to this or that. I mean, they're already doing that to a certain level. And I did listen to another speaker recently that talked about these audits and sampling just to what you said, is that they target certain people and certain demographics and audit everything that they're doing for a sample. And then they basically extrapolate and say people who have this size business are, usually making this mistake or whatever they want to try to sample. And then that's going to be a target for them. And so for cost seg, and they already do this now, and we know that and the thing is, it's difficult for them is actually to think about data inputs, is for them to figure it out. But everything is now e-filed, which now puts it all into their system in little boxes. They can say, I can see this purchase price and I can see this breakout. Essentially, it's depreciation schedules are done a little bit differently in each software and labeled maybe differently by different CPAs, but they already know whether you fall out of certain ranges or not. And then you're going to have a target on your back. But we're just moving towards the fact that if you move out of whatever range they've determined is appropriate, you're going to get a notice and you're going to have to defend it. Well, to be 100%, you have to, 100% of the people outside of those ranges will have to prove.
Yeah. Wow. Okay. Well, I mean, so it sounds like that's already in the works, and so maybe there will be. I mean, I tend to kind of just be a little bit hyperbolic with stuff I don't know about, and then this is like, to me, is a little bit, it's a big blind spot for me. I don't know what the IRS is doing, so I'm just speculating that they haven't really been doing much up till now, and that they'll continue not to do very much based on on recent on the recent election. So maybe it's that they already do have access to this kind of stuff, and maybe there is some sort of plan being hatched to, it's like, okay, they're going to cut our budgets. Well, then we'll use our budgets on on making this a much better mousetrap. And but look, I am the other thing that I'm skeptical about with AI, and I mean, I like to think I'm not close to, but I read about, I care about, I experiment with a lot of AI, is that it's still not really, there's a lot of sort of daisy chaining that you have to do to make these things work well. There's complex things, especially like, you need to analyze this or analyze that, and then it needs to kind of feed in, it's like you have an inputs into something that you're going to get like a kind of a more of like a complex output here, and then you need to kind of break it down and then send it into these different, other, I would say, like bots or other kind of things to make things happen in sort of an organized way. And I think right now the state of AI is such that, like, I definitely don't think that the IRS has the right people there at the moment to do that. So and because of the budgets, not getting better, I think that there'll be it'll be a difficult road uphill to get those type of people in the next couple of years. But who knows? As the easier it becomes, I think that, I mean, the thing about AI is it's just moving so fast. You might in 2 years, it might be so easy to build something that you could literally just, even if you're just kind of an amateur, you could say, hey, take this tax return, look at all the other tax returns that have ever been audited, and tell me whether you think we should audit this one. And they can just send it through. And it's like, whichever ones come back, and then they'll be like, okay, prioritize the clawback you think we can get, or obviously, for lack of a better word, prioritize the revenue that you think can be generated, and push, give us a prioritized list by revenue that we think we can get back, for all the ones that you think should be audited. And then it's like they can just start going through the list right from the top to the bottom. And yeah, I mean, if it's working very well, and they have all this reasoning that's already built up, just because the AIs are just getting that good, it could be a real risk. It's a lot of speculation here, obviously.
That's the direction.
I think
that's the direction we're going for sure. 100%.
Yeah.
I mean, at the end of the day, the administration can, turn a blind eye to, IRS agents, but they need the revenue. They need the revenue to come in. They have to have this arm of the government. They can't do without of it. And if you want to pass legislation and you want all these other things to happen that they do around the world, and they're going to need the revenue. And so
you want to annex Greenland,
if they want to buy
it's going to take
whatever, whatever the choices are, there's so many at one given time. It all takes money.
You're going to need good amphibious boats.
Yeah. I mean, it's fascinating.
As far as audits go, let's say, just kind of keeping down the same path, you say AI would kind of look for things that don't fit, if you think about an IRS agent in the old days, you know, they used to, you know, give a list of potential audits, you know, for people, and they would look, they'd have a list, and they'd say, oh, an apartment complex is going to reclass between this percent and that, and an office building is going to be between this and that, whether it's urban, you know, it might be a little less because land, like site improvements, but if it's out in a standard complex, it's going to get this range. They used to have a range, and if something didn't fall out of that range, they didn't audit it. You know, they're looking for things. So even if AI takes over, you've got an apartment complex, as long as you're somewhere between 18% and probably 35%, they're probably not going to audit you. But if it goes to 40% or 45%, they might take a look, you know, things that fall out. So if you're doing your work correctly and you're being fair with your allocations, you shouldn't worry about audits. Actually, audits are actually good. They ferret out the people that are cheating, you know, and they ferret out these calculators that, you know, are not accurate, you know, and we don't, you know, that's good for the industry.
Yeah, well, I will just take this a step further, though, John. Once the AIs get good enough, they can actually they can go in and look at without. This is basically what we're talking about, zero marginal cost of going in and evaluating whether the work was done correctly, despite them having a normal, you know, a sort of normal looking, you know, pattern, you know, following the pattern wise benefit. Why not? You know, if it doesn't cost, if it costs an extra 30 cents to look at everybody, you know, they can do it. And then, like, you know, you can be looking at something like, hey, you know, this person, you know, they don't, there is no, you know, there is no basis for this whatsoever. You know, but by the way, I mean, I guess one point to kind of take a step back on is the IRS doesn't have your cost segregation study, right? They just have, you know, the depreciation schedule that's going into the tax return. So, you know, maybe it would be based on, hey, did this person actually have a building, or is this just fraud? Things like that. But I mean, yeah, it'd be tough. I think what they might do, though, is once they can start processing more information, they might require you. And I think that this would be a positive development. Maybe they'll require that you actually, you know, you upload a study, and then the AI can take a look at it and be like, hey, this looks legit, or it doesn't, you know, because it's not going to cost them anything. It's putting up a link and then, you know, storage, and it's cloud space. And it's like, like I said, it's all about zero marginal cost to do extra checks. And if they can get more revenue, you know, if they can be revenue positive on that activity, then I think that they'd want to do it. But yeah, it could be, you know, we don't know how far off it is. At some point, AI will be able to line by line audit. Yeah, that is years down the road. Honestly, Matthew, I mean, I'm not saying that you're wrong. And when you say years, though, I mean, is it 1 year? Is it 2 years? Is it 3 years? So yeah, but I think, you know, it's still speculative, sure, and we don't know where it's going. I think, you know, I was listening to a podcast the other day, you know, of a guy who thinks that in 3 years, everybody will have a team of workers who will have like 4K generated video that'll look like John or Don on here, and they'll be talking to them, and that'll be like, this person won't exist, and you'll be like going over your strategy with them, your marketing strategy or whatever, you know, and you know, they'll be chewing gum just like John. It'll be uncanny, right? So like things are going to change quite a bit. I mean, and just in the world. So I mean, obviously, we probably, I don't know how much more we would like to speculate on that on this call, because I mean, this isn't just an AI call. So yeah, anybody have anything to add there?
No, it's just about cost seg though, and how it's going to affect, you know, I think that if you think about uploading your study, I think that will be maybe step 2, because all studies are different, and you probably could have AI look at it, but the first thing that they're going to do is make you check a box or somehow or another tag it, so they can tag it in your system, their system, that a cost seg study has been done and that you're following.
Well, yeah, so I was speculating that, like, if they wanted to get more, if they wanted the compliance to come more under heel, then then instead of just allowing you to put in the depreciation schedule, you know, they would say, okay, upload your cost segregation study also, and then we just have the AI look at it too. And then to me, I would love that. You know, I welcome that kind of thing, because that's what my company is all about, is actually having greater compliance, making things more robust, increasing the quality level. And then you know, when you can root out the people that are doing this, you know, for pennies on the dollar, because they're not actually doing it, it's just better for everyone here, I think.
Yeah, for sure. We actually had a question from Peter a little further up. How will AI advances affect the audit rate?
Oh, but
there's
that was the
different-
one I kind of,
Oh,
that
is
was
it?
actually how I started this. Yeah.
Oh,
But
is
go
it?
ahead.
Okay, sorry. Well, I
Yeah.
want to say, I don't know the words, but there's different levels of audits. So there's just the audits that, and Nico, I know you might know some of these words, but you have basically a field audit and a desk audit is what it used to kind of be called. But now there's different levels where you just get something in the mail and maybe there's no agent assigned to it. They just saw a disparity in your return, or then you might get, an agent assigned, but they're just asking you for files and you're never going to meet, or they might, meet you in person and kind of want to go over everything. But anyway, I think those low level audits will definitely increase. The ones where you're just getting a notice in the mail and you have to answer these questions or defend something via some arm's length sort of transaction in the mail or email or phone call will definitely
Well, it's so
increase.
funny that we're talking about even mail. It's like we're talking about AI and then in one breath and then mail in the next. And it's like, how ridiculous. But look,
It's crazy.
we are actually, everybody knows why this is. It's because of TurboTax. It's because of, H&R Block. I mean, these people have they have a lot to lose if the public at large stops paying them to do their taxes. And you make it easy to do it online, right? So if the government, I mean, look, I get it. Government's bad at a lot of things, but all you got to do is pay a private contractor to build, a very straightforward sort of tax system that nobody needs to use, H&R Block or TurboTax anymore. That would still leave the entire sort of like, I mean, the tax code is still pretty hard to parse at the higher levels. I think, I don't think anybody here would be super affected by that, but there's just, there is a lot of, let's say, political pressure, to keep it so archaic. Who knows how long that'll hold?
Well, the free filing system at the IRS has been expanded, and I think it is expanding every year as to who it can accept.
Yeah. Yeah, but guess what? They're not. They're doing a good. I think the lobbyists for those companies are doing a pretty good job of keeping that under wraps, right? And you're not going to ever see any marketing dollars like you see. They're not going to. The U.S. government free federal filing tax system is not going to be sponsoring a college bowl game anytime soon. So
No, I know.
or naming a stadium after the free filing system, just like they did here in LA. There's an Intuit Center here now. I'm going to really be on the Intuit's going to be on the warpath for me if this ever got out. But I mean, there's only like 50 people on this call, so I doubt it'll ever happen. So, okay. Anyone have anything to add to any of that? I know it's a lot of speculation, a lot of kind of just churning. As well, I won't bring that up. I had a really colorful professor in college who used to call it intellectual something, but I won't say what that was. And let's see. What's the last thing that we talked about? Where we
last
brought
thing
up
was
as
the bonus rules, which we've kind of touched on as well. What we kind of think. I mean, that's anybody's, guess as to what will. So many times when you get even temporary, regs, or even what came out last year, that they were trying to push through the Senate and the House. By the time it has actually become, a part of the tax code, it changes significantly. So it's hard to guess at any time.
Yeah. I was trying to think, John, we came up with something. Thanks, Jeff. We actually were talking about something this week, which was, hey, like there are some pretty complex things that can happen. Situations where this one I'm thinking of was that there was a tenant in an industrial building, and they'd been a tenant there for 30 years. And then I guess they were probably been trying to buy this building. I think they grew as an organization, and they just basically built a bunch of other things. But this one, location was either central to their operations, or, for some reason or other, it was pretty important. And so they kind of, they decided that they were going to buy out the owners. So, but they've had an interest, as we kind of came to the conclusion, John, in the property, in that they were, tenants. And so after they buy the building, what does the cost seg look like? And John, if you want to kind of just maybe go over what you think, and then we can open up to everybody here.
Well, yeah, so like I reached out to a CPA, and guess who I reached out to? Don Poland.
Don Poland.
So Dawn did some
Go figure.
research on this, so I'll let Dawn go ahead and speak to this point because she's very familiar with it, unless you can't remember all the facts.
Well, there was two sets of facts. One was when you're talking about bonus, application of bonus rules. When
Right.
you have an interest in the building, you know, at all. So being a tenant in the building is having an interest in the building. So if you're a tenant and then you purchase, you are not allowed to have bonus on your purchase. So that's one. And, you know, similarly, if you have a rental property and you primary residence and then you turn it into a rental, you cannot take bonus on costs that you do on that rental. So these all go hand in hand. But the second thing is, you know, what do you do with those tenant improvements when you purchase? And then you question whether you purchased it with an arm's length transaction. Did you pay the same price that anybody would have paid for that building? Because if you didn't happen to be the tenant, then and you had just a new owner of the building, you would continue to depreciate your tenant improvements and you just have a new owner. And that new owner would now be depreciating the entire building, not caring whether you have tenant improvements on your books. But I think that's the question that I was a little stuck on. I think they should probably either leave them on or write them off, but you really can't take gain or loss on that. I really didn't finish my research on it, so that's a big question mark to me. Does anybody have any thoughts on how you would treat the tenant improvements that were previously capitalized on their books as a tenant?
So just to be clear, just to make it a very clear scenario, facts and the fact pattern is important. You're a tenant for a long term, and it was a triple net lease. Because it was a triple net lease, anything that you wanted to spend, you know, on your space, you know, it's on you. And so they did. And so then now they want to buy the building. Okay. So then the question is, what happens, you know, on the purchase? And what Dawn's comment was that if you're buying it at fair market value, you should be able to go at, even though you're the tenant, you should be able to go over the property as it was at the date of purchase and be able to take all of those things, whether you as a tenant put them in or not. The thing that to remember is with the bonus rules, and this is where Dawn did some digging and she found the regs. And it's kind of fairly simple. It's like if the asset that you're buying is new to you, the keyword is new to you, then you're eligible for bonus. If it's not new to you, in other words, you know, you've had an interest in it, you don't get to take bonus. So that was the big thing that we came out of it. So those are the facts.
Yeah, and that ends up being a big deal, obviously, for these guys because you know, they're going to miss out on. I think they bought it in 2024, so they're missing out on 60% bonus. Pretty big deal for a cost seg.
It is in the first year, but you know, that we haven't always had bonus. You got to go way back. Got to go back, you know, pretty much prior to 2001. The bonuses, we've been living with bonus except for years, I think 5, 6, and 7, 2005, 6, and 7. There's been between 30% and 100% bonus all the rest of the years. So it's a very popular thing. That's why Richard mentioned earlier, it's like, or maybe it was Dawn, there was a bipartisan package, you know, to bring back bonus, but I'm sure there was lots of other stuff in that same package. And it was ready
the child tax credit was a big part of it.
But because we were in an election year, one side doesn't want to give the other side a win. So so Biden was in office. So of course, Trump didn't want to give him a win. So they just kind of blew that out and hoping to bring it back, you know, when, Trump, was hoping he would win and then they would bring it back. Or if the Democrats would have won, it would have come back on the floor, you know, because it was already there. But there's so many other things when all these tax bills, they don't have just one thing in them. They have like 100 things in them. You know, like everybody wants a piece, you know, or they're not going to sign off. So they bring lots of other things into that. It's not just a simply, oh, should we bring back bonus? It's got many other things in that same bill.
Can I ask a clarifying question to what just Don said? So I think you mentioned that if a owner lived in the residence and then move out of their primary residence into another and convert that primary residence into a long-term rental, you're saying that that old primary residence, which is no longer a primary residence, is eligible for cost seg but not eligible for bonus?
Right, you can do a cost seg, but not bonus depreciation. And that is actually something that when I was doing this research, I kind of came across. I didn't necessarily ever think about that because in my mind, I usually can just understand the where tax is going. Every dollar is taxed and kind of, where how they're making things fair. You have A, but not B. But when you have a primary residence, you didn't use that as a business asset. You didn't take any expenses on that. So how is that now that you had an interest in it that you can't do a bonus depreciation? I don't understand that, but I did run across rules speaking to that. Same thing with actually the lease. And then the triple, even though it's a triple net lease, yes, you're paying for everything in the building. You didn't own that building and you didn't get the benefit of the capital appreciation in that building. So saying that precludes you from bonus, I don't understand. I personally don't really understand why they have that rule. Honestly, I get it when you're talking about step ups. It's the same kind of thing. You had an interest in it before, like from inherited property. But hopefully that helps a little bit, Ro. I don't really totally know
So,
why.
this was a scenario for one of my clients last year. We did 7 or 8 of their properties. One of them, they were like, they converted them into Airbnbs, and one of them was a primary residence that they converted into Airbnb. And I know for a fact that their CPA took bonus depreciation across all the properties. Now, I just don't know how to go back to the client. Should I even should I just ignore it?
Well,
Because that's not my job. It's a CPA's
it's not
job. Yeah,
exactly. And I will tell you, that's what I've seen too. I don't know that any CPA I have talked to has not done that because they didn't know that rule. And so, honestly, I think me and you, I'm not going to go back. I don't want to be the bearer of bad news. Yeah. I mean, I think it's not necessarily totally fair, not that that's my decision to make,
make
but I think it's going to be very difficult for the IRS is probably not going to find out, and I don't think that people who've done that are like trying to get away with something. It is really just an obscure rule. So John asked whether the lessor, the remaining space that of the building that they didn't occupy when they purchased the building, if they could get bonus. And that is actually a really wonderful question. I think that there's two things to think about. I think my first thought might be yes. I think in this case, though, that was the whole space they rented. I can't
Yeah,
remember.
they were basically, they might as
Yeah,
well have just been
single
their
occupant.
space. They
Yeah.
were leasing the entire place and the parking lot, everything was all theirs.
Yeah. Yeah. So I think that just wasn't this scenario, but then I would just have to check on the rules of the the building itself is just the single asset. You know how that's, I'm forgetting the word now what the IRS calls it, but the building is the asset in total. So I would have to research that before I would be able to say yes or no, but it's a good point for sure.
The building envelope.
Oh, yeah, go ahead, Demon.
No, I think it's called the building envelope. That's what they call it.
Sure. What I was going to say was, I think this would be a pretty different case if they were a tenant of one space. Like, say there were 5 other tenants, and then they bought the whole building. I think you probably could take bonus on more than, or it's possible. I don't know. What's your take there, Don?
Actually, I was thinking the unit of property. So when you look at the repair and maintenance regs, they always refer to the unit of property. And even for cost seg, you've got the unit of property. And so
Well, I think what I'm thinking about is this tenant, and I think I might have gotten confused a little bit on the front end, but like if a tenant has, one space, well, they're probably depreciating their leasehold improvements and that's it, right? But then they purchase the whole building. That's a new asset to them. They didn't own the building before. They just owned some carpet, or whatever. So now they own the building, which they didn't own previously.
We had that very scenario before, and I rely heavily on our much of our work comes from CPA firms. That's who we market as CPA firms. So all of their clients, they're real estate people. That we get a shot at doing a cost seg. And so then I rely on the CPAs, especially if it's their client. And we had that situation. And so the area that they, so let's just say 40% of the building was occupied by the tenant, and then they buy it. They actually bifurcated it. 60% of the assets that weren't involved in their tenant, we had to break that out. They got bonus, but their space, they didn't get bonus. So we had to use on a depreciation schedule, kind of break those pieces and label them properly. But they took bonus on the parts that they did know that they didn't lease, and they took no bonus on the parts that they did lease, because they had made improvements along the way. And so I think, that was just the way they interpreted it, and I think what happens, we talk about audits. So I'm not trying to say you do what you want, because we want everyone to do the work properly. But if there's not a lot of audits, it's like back to Rose, something was done by a CPA, doesn't fall back on the cost seg professional. It was the CPA that elected to take the bonus, and chances are it's not going to get audited. There's not a lot of audits, and right now, over the next 4 years at least, it looks like, unless things change, that we might not have, this a lot of audits because of the workforce freeze and that type of thing.
Cool. Okay. Is there anything else to say there? Anyone else for now? It's my understanding that bonus is eligible during the year of acquisition of the property, which must comply with the year's bonus rules. Yeah, bonus eligibility is year of acquisition of the property. And it must comply with that year's bonus rules. I don't know if there's anything to say about that. Sean has a question here. Don, is there any specific about the IRS code that talks about this, meaning the primary residence turned rental property not being eligible for bonus? Don, did you want to touch that?
I will have to find it again when I did the research. I can't remember if I saved it, to be perfectly honest.
Yeah, I just see conflicting advice. I see this going back and forth like all the time. So I don't know what is true, what is
If it's interpretation versus actually written down. Yeah.
Yeah, and I also see it saying like people saying this is not true for primary residences converted into rental use, or properties converted into rental use. But like that's exactly what you're saying. The scenario is like specifically for properties converted into rental use. So I keep seeing it back and forth. I'm not sure what is true, but I've never had like somebody's tax CPA come back and say
that. I haven't either, and I think it could be an interpretation. I will try to find it though. I mean, I think if you say that somebody has a lease and then they buy the building and they can't, then it's the same kind of concept a little bit, even though one was never a business purpose asset, which is where, I do get kind of tripped up on that. It doesn't really make a lot of sense to me. And I think, I like to understand why the IRS makes these rules. Are they trying to keep people from converting all their primary residences into a rental and for like 1 month, but actually still living in it? Like, what are they trying to keep people from doing that they think is going to be some out of control situation out there? Maybe that's it. But I will dig it up, and maybe on our next call, I will try to bring that back around.
Yeah, I'd be interested. I feel like it would be, to me, it seems like an extremely conservative approach to not take accelerated depreciation.
I agree. No, I agree. And everyone I have talked to has, because I actually wasn't aware.
Accelerated depreciation and bonus are different. I mean, so in this case,
well, yes, you're right.
What do you mean by that exactly, Richard?
Methodology.
So accelerated depreciation is so that's what you get with a cost segregation, but that exists prior and apart from a bonus. The bonus is just new rules that are applied, on a yearly basis. From obviously TCJA was one of the bigger ones, that you can get bonus for property that was accelerated 20 years or faster. So those are two separate things.
So you're saying you can reclassify things into 5 and 15-year life, but not take the 100%, or for 2024.
That's
60.
right. So cost segregation as an idea has existed far before any of that, right? So like and basically that's the idea of cost segregation, is pushing things into shorter life property. So the makers were, modified accelerated cost recovery system is sort of the newest form of that. you know, in 1986, the rules start, you know, kind of changed over then. But yeah, even before that, you could take sort of accelerated depreciation on things. So yeah, those are two separate things. Whether you can take bonus on it or whether you can accelerate the depreciation.
Yeah, I get what you mean from a sorry, this terminology standpoint. I understand what you're saying though.
There's a lot of jargon here.
There's
Sorry, I just wanted to
bonus.
make the distinction.
I think the prohibition on the bonus in that situation Don's been describing, I think there's a prohibition on bonus for transactions involving related parties. So I think what they're trying to prevent is people having non-arm's length transactions just to create bonus depreciation.
Yeah,
That makes sense.
that sounds
I
right.
agree. I think that's really what it is that everybody then, because you know, obviously you can't do a cost seg and get bonus on your primary residence, keeping people from saying, I rented it in December last year and now it's a business asset and I'm going to take all this. Yeah.
Sure. Yeah.
But yeah.
Yeah, that makes sense. You know, I think they're thinking that most people are just much more opportunistic than but I honestly, I mean, they have to deal with the surface area of attack that's much greater than what most people have to. So, you know, if they're not preempting a lot of things, then yeah, that you know, the bigger the loophole, you know, the more people are going to just jump through it without them even, anyway, that's just kind of conjecture there. Okay, so Bridget says her point was missed. I believe my point was missed. As in, a homeowner who has had a residence since 1990 before bonus rules can never have a bonus allocation applied to that residence if it is now generating rental income in, say, 2024, which would have 60% bonus. I'm pretty sure I know the rule here. It's the bonus eligible rules are when they acquired the property. Yeah, that's right. So you can't get bonus on it now just because they started renting it, you know, later. Dawn, what do you think?
No, that's not true, actually. So
Oh,
no
I am
matter
wrong.
when you bought it, so it's when it's placed in service. So if she transformed it into a rental in 24, she would take her purchase price from 1990. Now that's a
Oh,
business
it's the
app.
purchase price.
And then, the date would begin in 24 and the bonus rules would tie to the date. Yeah.
Okay.
Yeah.
So yeah, you just have to take, I mean, obviously she paid a lot more. Yeah, this is the date, no matter the purchase date, bonus allowed. Okay, yeah. Well, I was wrong on that one.
Hey, question, Don. On that note, I've followed that premise, but what will you use for the land value? Do you go back to purchase date or do you do the current?
Yeah, I think you do.
year?
I would like to go
You
back
need
to
to.
purchase date. I don't know if you could go back that far, but generally when I have like a property, I had one like yesterday that was purchased in 19. I'm going to follow the 19 land allocation if I have that data. I think that's
Yeah, I mean, it just doesn't make, it has to be apples to apples there, right? Because I mean, like the land value, like, you know, just imagine the land value could have appreciated way past what you paid. It could be
Right.
more than what you paid, right? So
Right.
John is saying, I think you actually use the appraised value when you convert from personal use to business use. Do you want to elaborate on that, John? Or anyone?
I
Tom
think that
McCallum?
I don't
the
have
reason
that right
why
in front of me,
think
but I'm thinking if like in that instance where you're saying somebody owned their house since 1990, converted it to a rental property on, let's say 2024, I think you would get an appraisal in 2024. And that's what you would use as your basis for your depreciation. Right? You wouldn't use your 1990 purchase price. So you would actually, I may be wrong on this. So this isn't gospel, but I'm thinking that you do get a step up there as whatever that appraised value
I'm
is.
pretty sure you don't. I guess I'd be interested to
Okay.
see if
You
you
could do
Because
done
but what's your
another way.
basis? You're saying that the basis they could actually
Fair market
depreciate more
value.
than what they paid.
Yeah,
Yeah.
because I think you use fair market value when you convert from. I
This would
may
be
be
the
wrong.
first time in the code you only get a step up in kind of free money, so to speak,
Okay.
really on death and different things. A step up in like a partnership interest, you still have cash. One of the ways that I said I always kind of think about how tax is done is that, you know, every dollar is taxed, but not taxed twice. So you've paid tax on the money that you bought that house for in 1990. And then you wouldn't get the fictitious money if you whatever you capitalize on your depreciation schedule. The whole point of it is that you've paid tax on those dollars, just like the bases that you have in your stock that you bought, or the basis in a partnership interest you have. When you're tracking that, they're really tracking the dollars that have and have not yet been taxed. So them giving you the ability to have this free money pot and act like it's been taxed when it actually hasn't, I would be shocked. There's no other place in the code that lets you do anything like that.
Oh, except on death, right?
Except on death, and that goes against your lifetime exemption. It's not that it's
Okay.
like free for all pass. You've got these exemptions. It depends on what you die. Obviously, you need to plan that out very carefully. And then that's how much of your money is going to pass down to the next generation tax free. They want their hand in that pot too.
Nico, I didn't quite understand everything you wrote here. So do you want to chime in? LV ratio, if purchase date, IF purchase date. Good.
No, we're good. Don actually summarized very well. I appreciate that. I was just reinforcing what Don was saying.
Okay, great. Awesome.
Yeah, thanks, Nico.
Let's see if I did. Please chime in if you think we missed anything else. I didn't know what this means, RESP, Richard Rios. Do you what do you mean by RESP? I don't know that acronym.
It's a real estate sales professional status. And
oh, sorry. All right, yeah, rep status. Okay.
Yeah.
I just say it REP, but okay.
Oh, okay. Yeah. No,
okay.
I
thought
you had to be a real estate professional, which is probably more accurate to what you're saying it, in order to take the 100%. I thought otherwise you could just do the depreciation schedule.
Don, why don't you just take that one just as a general case? It's not that's so for a short term for what would typically be like a rental property. If you had like passive income, there's things like that. But then you have grouping on your tax return. There's a lot of other ways that you can get this to hit sort of, commingle. I would say commingle these things together. Go ahead, Don.
Yeah. So for any rental you have, you can do accelerated depreciation. You can take bonus. Now, how you apply that on your return, and if you can actually use that extra depreciation is another question. So on your tax return, you have your regular ordinary income, your earned income. You have your passive income, which is where rental real estate falls. And then you have portfolio income, which is interest and dividends and those type of things. So those buckets don't play with each other. The only way to get your passive bucket, so if you have a cost seg study in your passive bucket and all of your passive activities in that bucket, your rental properties are generating income, then you can use the bonus rules to bring that passive bucket down to zero and beyond, carry that loss forward to your next year's passive. But the only way to get, if you aren't making enough passive income and you really want to use it in your active bucket, you have to be that real estate professional status to breach it, or you have to use the short-term rental loophole to breach that. That's the only way.
Okay.
Buckets. Yeah.
Thank you. That makes sense. Thank you.
You're welcome.
So basically you're using your passive losses, depreciation losses against your active income, but you can only do that as a real estate professional.
Right. Or if you're using the short-term rental.
Short-term. Yes.
Yeah.
Thank you.
So that in those cases, it's completely advantageous to always do a cost seg on your rentals. Those are like the landslide wins when those are the situations.
Got it. Thank you.
What about so general, this might be worth just talking about really quick, Don, is like in the general case, you're an owner operator, you have an entity that owns and operates a building. That is also it's because they're the same, that that's just the same entity that all hits the same set of books, right? So you can take the depreciation against any taxable income for that entity as well. So in most cases, we're talking about commercial real estate. That's kind of how that's where this plays.
Yeah, that's a whole different kit and caboodle, Richard, honestly. So if you've got a commercial property and you're renting to yourself and you have your entity, let's hear it. So then that's called the self rental like trap. That's probably a whole nother, you actually, you have to charge yourself like a market rent, and then you can't just take, that's actually one of my least favorite areas of working with people, is if they've got a self rental, even though it's in another LLC. It's what
if it's the same? I mean, if it's the same, it doesn't matter, right? That's the whole that's kind of the most common.
If it's the same, then yes.
Entity.
Okay. If it's the same,
right. You're owner operator.
You are owner operator and you don't have it in another entity. So then you're not charging rent to yourself, back and forth. You're not charging rent. You don't have rental income. It is just an asset on your books. You can cost seg it. Yes, that is. But most of the time, your lawyer tells you put that real estate in its own LLC, and it kind of creates this whole trap, because now your LLC has to charge you a rent, and you pay, and then they don't want you to take that loss from the one entity and collapse it. You can, there's a
Grouping of assets, I thought. I mean, or
grouping
grouping
assets. Yeah, the grouping
sorry,
election.
or sorry, grouping of activities. Sorry.
Yeah, you can do that, but then there's things to think about. Actually, there's one CPA in particular, well, him and I go back and forth on this a lot. It depends on just the situation and but it's a bad
Well,
area.
isn't this exactly the case when you're doing a short-term rental? Because when essentially short-term rental status allows it not to be a residential rental property. And then you need to group the assets, you need to group the activities with your other income in order to be able to, for it to be active, the depreciation to hit that active income. No?
Well, I mean, I see what you're saying, but you don't have an. Yeah, I'd have to think about that as to how those are actually similar. I mean, I guess I'm thinking about it. We're kind of talking specifically at the 1040 level, which I know a lot of business income is going to flow down there on a K1 anyway. Let me noodle on that and let's talk about that next time. Yeah.
Well, I didn't mean to. I'm not trying to catch anybody by surprise. I just think, this kind of thing. There's definitely so many things I don't understand about the tax code. And this was one of the things where I kind of stopped. I was like, okay, it's not residential rental anymore. So you've got kind of like this different thing going on. But then how does that actually, like, what are the rules that govern, after the short-term rental status is, it seems like kind of a hand wavy thing to me. Anyways, maybe we can tackle that next time. It does look like we're kind of getting to the end anyway, and then we'd be more prepared for it. Can you expand on the short-term rental loophole? We can next time because we'll be more prepared. Does anyone want to, anybody from the group, feel free to open up and if anybody here cares to chime in on that.
I actually have a question for Don, Richard. I just wanted to get your feedback really quick, Don. With with Trump now in office, the Inflation Reduction Act, I think it's going to be something that he's going to go against it pretty hard, going away from a lot of, energy, credits and things like that. What's your take on 45Ls? Do you think we're still going to, what's your feedback on that? I know that is kind of like a little bit off topic. Do you think we're still going to be, that's going to be something that Trump is probably going to focus on, or we're still
I
going to
think
see
he will
those?
focus on it. I mean, he said on his platform that he really wanted to get rid of a lot of that stuff. Whether he gets rid of it or not, historically 179D and 45L were always in the extenders package. So they sort of crippled along in and out, in and out. And in my personal opinion, with the prevailing wage and apprenticeship programs being attached, it's crippled those programs anyway. I think they're very likely to either get nixed altogether, or this would be wonderful if he would just detach it from the prevailing wage requirements. But he is pretty intent on, it seems so far the first week, doing what he said he was going to do. And he said he was going to roll back a lot of those incentives from the Inflation Reduction Act.
Yeah, that's my feeling too.
Rough.
Yeah.
Just trying to see if we missed anything. So Rohit, did you get your question answered with the bonus 60% last year with this new the new rule allow balance 40% this year? So the way that works, if you have 60% bonus and you take it, all of the rest of that residual depreciation you take it as normal. So it's almost like 40% of the basis gets depreciated normally. Does that make sense?
Yep, it does. I was just wondering if, there's Trump's always bent upon getting 100% bonus depreciation. If there was a way that he would allow
to get the rest of it, you mean?
Yeah, rest of it. Yeah.
Oh, that would be that's something they could do, right, Don? They could just be like, hey, if you depreciated anything and now we'll just get you 100. I mean, you could just say, okay, allow the rest of the expense instead of doing it like last year. You just take it this year as the rest of an expense. That would be one thing. Rohit, get on that. Start lobbying Congress. I think there's going to be a receptive audience over there.
Well, this is the second rumor we are starting, right? After your
first, right? Second rumor.
Well, if one tweet and it's done, good. Yes, Peter, let's do it. Let's slip into Trump's DMs and we'll see what we can do. If I'm not going to tell him anything about what I said, because that would basically negate all of this, and we don't want that. So, I think Rohit's got the idea here. All right, it's 11:59. I think that's going to be it for this one, guys. Appreciate everyone being here. Once again, the more people that chime in, the more people that come to these really appreciate, it makes it better. And so we appreciate everybody coming. Thank you, Dawn. Thank you, John. Thank you everybody who participated.
You're welcome. Thank you.
Have a
Bye,
good rest of your day.
everyone.